Hi, I'm Kevin McPartland, Head of Research for our Market Structure and Technology practice. Today is August 11th. U.S. Treasury market activity remained notably muted in July. The average daily volume was down 22% from June and 8% from the same period a year ago. Volatility also declined again, down 18% from the previous month and 25% from July 2019. Activity did start to pick up slightly toward the end of July, but not enough to bring up the monthly average or to signal an upward volume trend. Derivatives markets were also quiet by historic standards. The average daily volume for CME U.S. Treasury futures in July was down 41% from the same month a year ago. The reduction in volume was greater than in the cash market, which can be seen in the futures to cash volume ratio, which is the total U.S. Treasury futures volume divided by U.S. Treasury volume. This averaged 45% in July compared to 64% the year before. Diving a little deeper, the average ratio for all of 2019 was 76.2%. The average for 2020 year to date is only 66%, and the average from March to July 2020, from the start of the COVID crisis, is even lower at 50%. Historically low rates and other market dynamics have made pre-COVID futures to cash basis trading strategies less profitable, causing some market participants to look elsewhere for profits. This basis trade has been a strong driver of futures market activity and as such hurt the overall market volumes. Whether or not this new dynamic is a structural change is unclear, although it seems unlikely market activity in both futures and cash will remain depressed forever. Electronic trading, on the other hand, has held its ground quite well, particularly in the dealer-to-client portion of the market. Bloomberg and Tradeweb collectively handle 52.6% of electronically traded volume in July, 29.4% of the overall market volume, each accounting for about half of that total. Conversely, central limit order book volumes remain depressed, accounting for just over 24% of total market volume in July. This trend is likely linked to the decline in basis trading outlined before. The lack of market volatility certainly doesn't help central limit order book activity either. But even with volumes down, primary dealer net positions have continued to increase. Dealer U.S. Treasury holdings are up 4% in July compared to June, and up 9% from the same month last year. The makeup of those holdings look quite different from last year, however. In July, bills made up 38% of the portfolio by notional value. In July of 2019, bills accounted for only 6%. This reflects the U.S. government's issuance over the past few months. That has led overall outstanding notional for bills to grow in earnest since March. Thanks so much for listening. Again, this is Kevin McPartland from our Market Structure and Technology team here at Greenwich Associates. We'll keep an eye on the markets, and we'll talk to you again next month. Thanks very much.